Hi, I'm Pattu from freefincal. Today, let's take a look at how to find consistent mutual fund performers using my monthly mutual fund screener. I will take the example of ELSS mutual funds. Before I do that, a couple of announcements. One is Suhas Bharadwaj has shared how he tracks his investments and financial goals in a very elaborate way. Please check out this post either at freefincal.com or you can go to the community page of the YouTube channel. I had asked readers of Facebook group Asan Ideas of Wealth if they would be willing to share their review of their portfolio as an article for Free FinCal readers, and I have received two wonderful articles. This is one. I'll post the next one next week, and after that, I'll post my own audit. The 40% discount on the goal-based portfolio management course. This is a set of videos hosted in a Facebook group is still on. You only have to pay 1,800 to get in, and the discount is still on, and that's a 40% discount of the full course. So check out this link right there or at freefincal. All right, so I'm going to show you my this is the Excel screener. This is there are two types of files you will get when you buy the screener. The cost of the screener every month is just 111 rupees, excuse me, 111. You get two files for it. One is a Maxcro screener, which you can use to select files in an automated way by a click of a button. The other is just the bare data file. You can use it on Google G Drive or any other spreadsheet software. So let's get rid of my face and let's talk about mutual fund screening. So here, let me first clear all the filters, and it's going to show you this. So now you can actually select the fund category that you want to screen, or you can select the benchmark and find all the funds listed against that, and you would see the results in this results page. There's also another kind of screening where I use the trailing returns. That is, I look at the last 1 year, 2 year, 3 year, 4 year, and 5 year returns, and I also look at the 1, 2, 3, 4, 5 year volatility of the standard deviation, and I find out the funds that have given returns more than the benchmark and at a risk lower than the benchmark. You can go have a look at that, and when you screen there, the so let's come back to this main screener and I'll explain what the results are. So the first thing I do is I just cleared all the filters, and next I'm going to choose ELSS funds, and when I do that, you will find about 41 funds here. That's 41 here. There are two funds from Aditya Birla. Let me just Birla Sun Life has got two ELSS funds. One is a closed one. The one is called the closed one is called Tax Plan. The other one is called Tax Relief 96. That's their own fund, which is open for subscription. But the Tax Plan is closed for subscription. But the existing investors can still, they are still invested in the fund, and the fund is still open in that sense, and they can redeem as and when their units mature. So we have 41 funds, and the first screen that I want to employ is I'm going to say that over every possible, let me just get this here. So I'm going to look at rolling returns, and I'm going to say that over every possible 5-year periods between the 1st of January 2013 to December 8th, 2020, I want a fund that has outperformed the benchmark. In this case, it is Nifty 200 total returns index at least 70% of the time. So if we have 100 5-year returns, then the fund should have outperformed the index at least 70 of those times. So if I do that, then I can, if I click on that, that's the screen applied, then the 41 number reduces to 21. And if I ask the same kind of filter on these 21 funds, that is over every possible 4-year returns, the fund should have bet the benchmark at least 70% of the time. Then the 21 becomes 16 funds, and if I do it for over 3 years, then I have 14 funds. This is enough. In general, this is enough. But then again, now we are in a nice bull market, so you have a lot of outperformers. But then if you have a bear, if you're in a bear market, the number of outperformers would come down and so on. That's the reason why I publish it every month to get some kind of history. This is it, and if you want a further filter, you can actually, to be honest, you can choose one, or you can use what I call as the downside protection. So what I do is for example, if I take a 5-year duration, I look at monthly returns and I ask, whenever the benchmark return is negative, has the fund return been more negative than that or less negative than that? That's what I call as the downside capture. I have explained this in several videos before. So I define how frequently the downside capture of the fund is less than 100%. That means that how frequently the fund has fallen less than the benchmark, and that I call as the downside protection consistency. And that consistency I can ask it to be greater than 70%. So I demand that over 5 years, then I have 13 funds. I demand that over 4 years, one fund more drops out, and then over 3 years, then I have about 12 funds. So these are 12 funds. These 12 funds have very good return outperformance consistency as well as risk outperformance consistency. And then if you want to further filter this out, you can demand this, or you can demand return outperformance over 2 years, then over 1 year, and risk outperformance, and so on. Those are the 7 funds which I have mentioned in the article. Both the funds of Aditya Birla are here. Then you have BOI tax advantage, DSP tax saver, Invesco, Kotak tax saver, JM tax gain, and so on. You won't find the new funds, new kids on the block like Mire and PPFS won't be there, because they just don't have that 5-year history. But it's up to you. If you want to look at 1 year, 2 year history, you can screen as per that. It's up to you. I mean, all that matters is your own comfort level with respect to investing in a fund. Of course, these are all actively managed funds. There is no index fund in the ELSS category, although there can be, but the fund houses will not do it because they want a profit, and therefore they will not do it. But the other question is that should I even invest in an ELSS fund? And I have talked about this before. If your asset allocation is such that you can manage with the PPF, EPF, etc., or then you don't need ELSS. You can somehow manage that 50-60% equity from elsewhere and manage your tax saving from EPF and PPF. Then you don't really need ELSS fund. So it's up to you how you plan your asset allocation, and if an ELSS fund is something that you want, then you can consider screening this way. Of course, no screener is perfect. Every screener will be different. You can have different, it's all like blind people touching an elephant. So each person will come out with different results. It's about what you believe is important and what you believe is what you are comfortable with, and that's about that. So do catch Suhas's post, and I'll catch you later. Bye bye.